Every financial system has a weakness, and somewhere buried inside the walls of central banks, inside the fine print of trade agreements, inside the silence of financial media, there is a name they keep off the front page, a metal, quiet, undervalued, systematically ignored, while the ultra-wealthy have been moving it in the shadows for decades. The question is not whether silver matters. The question is, why are they working so hard? To make sure you never find out that it does. Welcome to Finance Brief, the channel where we do not guess, we analyze, where we do not follow the noise, we follow the money. Now, before we go any further, if you have been watching this channel for a while and you have not subscribed yet, that is like reading a newspaper every single morning for 30 years and never once paying for a subscription. My friend, it is time. Hit that subscribe button. It costs you nothing, and it may one day be worth everything. And one more thing. We have viewers joining us from every corner of this world, and honestly, that never stops being remarkable to us. So tell us in the comments right now, which city, which country are you watching from today? Drop it below. Let us see just how far this conversation travels. Now, let us talk about what they do not want you to know. There's a question that serious investors have been asking for decades, and it is not a complicated one. It goes like this. If silver is just an ordinary metal with no special relevance to the modern economy, then why does every major financial institution in the world have an opinion about it behind closed doors? The answer to that question is the entire point of this conversation. To understand where silver stands today, one must first understand where it came from. For nearly 5,000 years, silver was not a commodity. It was money. Civilizations from ancient Mesopotamia to the Roman Empire to the trading ports of medieval Europe conducted their economies on silver. It was portable, divisible, durable, and universally recognized. When a merchant in ancient Athens completed a transaction, he did not think of silver as an investment. He thought of it as the transaction itself. This matters because it establishes something important. Silver did not become money because governments decided it should be. It became money because human beings, across cultures and centuries and continents, independently arrived at the same conclusion. Silver held value. Silver was trusted. Silver worked. Then, in the 20th century, something changed. Between 1870 and 1971, the global monetary system went through a series of deliberate restructurings. First, major economies moved away from bimetallic standards, monetary systems backed by both gold and silver, toward gold-only standards. Then, in 1971, the United States severed the dollar's last connection to gold entirely. The result was a fully fiat monetary system, meaning the value of currency was no longer tied to any physical asset. It was tied instead to government authority and institutional trust. For gold, this transition was complicated but survivable. Central banks continued holding gold. It remained a recognized reserve asset in international finance. The world disagreed about its price, but nobody seriously argued that gold was irrelevant. Silver received no such treatment. After demonetization, silver was quietly reclassified. It became an industrial commodity, grouped alongside copper and zinc in the minds of financial analysts, stripped of its monetary identity, and largely removed from serious macroeconomic discussion. Financial media moved on. Central banks stopped talking about it publicly. The investment community followed the signal and directed its attention elsewhere. But here is what is interesting. While the public conversation around silver went quiet, the private conversation never did. Commodity desks at major banks continued trading it in enormous volumes. Government agencies that monitor strategic resources continued tracking its reserves. Certain sovereign wealth funds and private family offices, the kind that manage generational wealth rather than quarterly returns, maintained quiet, consistent positions in physical silver throughout the decades that followed. The silence was not universal, it was selective. And selective silence in the world of finance is never accidental. Consider the logic. When an asset class disappears from mainstream financial coverage, there are generally two explanations. The first is that the asset has genuinely become irrelevant, that market forces have rendered it obsolete, and no serious capital allocator sees value in it. The second is that the asset's relevance is precisely the reason it is not discussed, because drawing public attention to it would create consequences that certain institutional players are not prepared to manage. For silver, the evidence points heavily toward the second explanation. In 2023, global silver demand reached record levels. Industrial consumption alone accounted for more than half of total demand, driven by sectors that will be examined in detail later in this analysis. Meanwhile, mining production failed to keep pace. The Silver Institute, which tracks supply and demand data for the global silver market, reported a structural supply deficit for the third consecutive year. This is not a minor data point. A persistent supply deficit in any commodity market is a fundamental signal. It means the world is consuming more silver than it is producing. And yet, if one were to turn on any major financial news network on any given day, the probability of hearing silver discussed in any serious analytical context would be remarkably low. That gap between what the data shows and what the public is told is not a coincidence. It is a policy. And understanding that policy is where this analysis truly begins. In 1980, silver did something that made the entire global financial establishment deeply uncomfortable. It rose to $50 an ounce. For a brief, extraordinary moment, silver was not behaving like an obscure industrial metal that had been quietly removed from monetary conversation. It was behaving like what it historically was, a store of value responding to inflation, currency debasement, and institutional instability. Ordinary people were selling their silverware. Families were liquidating jewelry. The price signal was loud, clear, and deeply inconvenient for a financial system that had spent the previous decade trying to convince the world that hard assets were relics of a less sophisticated era. The establishment responded with force. The Hunt brothers, two Texas oil billionaires who had accumulated an enormous silver position, were made into the public face of the price spike. Regulatory bodies changed the rules mid-market, restricting silver purchases and allowing only sell orders on futures exchanges. The price collapsed. The narrative that followed was carefully constructed. This had been a manipulation attempt by wealthy speculators, and the system had corrected it. What that narrative conveniently omitted was the structural question it left unanswered. If silver's price spike was purely the result of two men cornering a market, then the asset itself posed no systemic threat. But if the price was also responding to genuine macroeconomic pressures, inflation, dollar weakness, loss of institutional trust, then suppressing it required more than punishing two individuals. It required building a permanent architecture. That architecture exists today, and it operates through the paper-silver market. To understand this, one must first understand the difference between physical silver and paper silver. Physical silver is the metal itself, bars, coins, and industrial inventory that can be held, transported, and verified. Paper silver is a financial contract that represents a claim on silver without requiring the actual metal to change hands. Futures contracts, exchange-traded products, and over-the-counter derivatives all fall into this category. The paper-silver market is vastly larger than the physical market. On any given trading day, the volume of silver traded on paper exchanges represents a multiple of the total physical silver mined in an entire year. This ratio, paper claims to physical supply, is the foundational mechanism through which price is managed. Here is how it works in practice. When genuine market demand begins pushing silver prices upward, large financial institutions holding significant short positions on paper exchanges can increase those positions, adding downward price pressure without ever touching a single ounce of physical metal. The signal that would ordinarily communicate scarcity or rising demand to the broader market is absorbed and neutralized before it can translate into a price movement that would attract public attention. This is not a theoretical argument, it is a documented pattern. The Commodity Futures Trading Commission, the regulatory body that oversees these markets in the United States, received a formal whistleblower complaint in 2010 from a trader named Andrew Maguire, who described in precise detail how silver prices were being systematically suppressed through coordinated trading activity on the COMEX exchange. The complaint named specific institutions and specific trading windows. It described the mechanics of the operation with the clarity of someone who had observed it firsthand. The investigation that followed produced no prosecutions. In 2020, J.P. Morgan Chase, one of the largest players in the silver futures market, paid nearly $1 billion in fines to resolve charges of market manipulation across precious metals markets. Traders at the bank had engaged in a practice called spoofing, placing large orders with no intention of executing them, purely to move prices in a desired direction before canceling the orders. The Department of Justice described the conduct as a years-long criminal scheme. The fine was paid. The practice had already run its course, and the broader architecture that enabled it remained entirely intact. What this reveals is not the story of isolated bad actors making individual decisions. It is the story of a system in which certain price signals are considered too dangerous to be allowed to express themselves freely. Silver's price, if left entirely to the natural forces of supply, demand, and monetary reality, would communicate information that institutional players and monetary authorities have a direct interest in suppressing. That information concerns the true condition of the currency system itself, because historically, when silver rises, it does not rise alone. It rises in response to something. And what it responds to is the thing that the current financial order is most invested in keeping quiet. There is a version of the silver story that the financial establishment is comfortable telling. It goes like this. Silver is a niche precious metal, largely a relic of older monetary systems, with some modest industrial applications and a small community of enthusiastic retail investors who collect coins and talk about conspiracies on the internet. It is not a serious asset class. It is not a strategic resource. It is not something that the architects of the modern economy spend significant time thinking about. That version of the story has one problem. It is no longer supported by the data. To understand what is actually happening with silver in the global economy, one must step away from the financial markets entirely and walk into a factory. Specifically, the kind of factory that manufactures solar panels. Because it is there, on the production floor of the renewable energy industry, that the true nature of silver's modern role becomes impossible to ignore. Every single crystalline silicon solar panel produced anywhere in the world today requires silver, not as a decorative component, not as a minor trace element, as a functional conductor. Silver paste is applied to the surface of solar cells to collect and transfer the electrical current generated by sunlight. There is currently no material that performs this function at the same efficiency level at a commercially viable cost. Manufacturers have spent years and considerable research budgets attempting to reduce silver content per panel or identify a substitute. The reductions have been incremental. The substitute has not arrived. And the world is building solar panels at a scale that would have been considered implausible a decade ago. In 2023, global solar installations exceeded 400 gigawatts, a record that surpassed the previous year's record by a significant margin. The International Energy Agency projects that solar capacity will continue expanding aggressively through the remainder of this decade as governments across Europe, Asia, and North America pursue legally binding emissions targets. Each gigawatt of solar capacity requires a calculable quantity of silver. The math is not complicated, and when one runs the numbers against current and projected mining output, the conclusion is significant. Solar is not the only sector placing pressure on silver supply. The electric vehicle industry, which has grown from a niche market to a central pillar of global automotive strategy, in less than 15 years, uses silver extensively. It appears in EV charging infrastructure, in the battery management systems that regulate power flow, in the numerous sensors and switches that modern vehicles require to function safely. The average electric vehicle contains between 25 and 50 grams of silver, depending on the model and its level of technological sophistication. As global EV production scales toward the hundreds of millions of units per year that industry forecasts project, the cumulative silver demand from this sector alone becomes a number that commands serious attention. Then there is the semiconductor industry. Silver is a critical material in the production of semiconductors, the microscopic components that power every digital device on the planet. As artificial intelligence infrastructure expands, as data centers multiply, as the digitization of industrial systems accelerates globally, semiconductor demand grows with it. And semiconductor demand carries silver demand as a direct consequence. What emerges from examining these three sectors together is not a picture of a niche metal with modest relevance. It is a picture of a material that sits at the intersection of every major technological and energy transition the world is currently undergoing simultaneously. Now consider the supply side of this equation. Global silver mining output has remained largely flat for several years. The world's primary silver mines are aging. New discoveries of significant silver deposits are rare. A substantial portion of silver supply comes not from dedicated silver mines, but as a byproduct of copper, lead, and zinc mining operations. This means silver production is partially dependent on the economics of entirely different commodity markets, creating supply dynamics that cannot simply respond to silver demand on their own terms. The result of accelerating demand meeting constrained supply is not complicated economics. It is a structural deficit. And a structural deficit, sustained over years, does not resolve quietly. It resolves loudly. The only remaining question is when. There is a particular kind of financial intelligence that does not appear in textbooks. It does not come from quarterly earnings reports or analyst upgrades, or the rotating cast of commentators who populate financial television. It comes from a much simpler discipline. It comes from watching what powerful institutions do, rather than listening to what they say. And what powerful institutions have been doing with silver, quietly and consistently, tells a story that is fundamentally different from the one being presented to the general public. To understand why individuals, particularly those serious about long-term wealth preservation, are beginning to pay close attention to silver, one must first understand what suppression of an asset class actually looks like in its later stages. Because suppression, by its very nature, is a temporary condition. It requires continuous effort, continuous institutional coordination, and continuous public indifference. The moment any one of those three pillars weakens, the dynamic begins to shift. History offers a precise template for what happens next. In the 1970s, gold was suppressed, undervalued, and largely dismissed by mainstream financial institutions following its demonetization from the Bretton Woods system. The official position was that gold was an outdated relic, that modern monetary systems had evolved beyond it, and that serious investors had no business treating it as a strategic asset. Then inflation accelerated, dollar confidence eroded, and gold moved from $35 per ounce to over $800 per ounce within a decade. The investors who had listened to the institutional narrative lost the opportunity. The investors who had read the structural signals did not. Silver is not gold. The two assets have different supply profiles, different demand drivers, and different relationships with monetary policy. But the pattern of institutional dismissal, followed by structural revaluation, is not unique to gold. It is a recurring feature of any asset that has been systematically undervalued relative to its fundamental scarcity and utility. And silver, by virtually every objective measure currently available, meets that description precisely. Consider the gold to silver ratio. This metric measures how many ounces of silver are required to purchase 1 ounce of gold. Historically, across centuries of monetary systems that recognized both metals, this ratio averaged between 15 and 20. That ratio reflected the approximate natural abundance of silver relative to gold in the Earth's crust. Today, that ratio sits at approximately 80 to 1. This means silver is historically undervalued relative to gold by a factor that has no precedent in peacetime economies with functioning markets. There are two possible explanations for this divergence. Either the historical ratio was meaningless, and the current ratio reflects genuine market efficiency, or the current ratio reflects the successful suppression of silver's perceived value over several decades, and the historical ratio represents the equilibrium toward which silver will eventually return, as industrial demand overwhelms the capacity of paper markets to manage price. For anyone who has followed the industrial demand data examined in the previous section of this analysis, the second explanation carries considerably more weight. Now consider what the discouragement of retail silver accumulation actually signals. When financial media consistently steers retail investors away from an asset, when major banks maintain large short positions against it, when margin requirements are raised precisely at moments of price acceleration, these are not the behaviors of institutions that consider silver irrelevant. These are the behaviors of institutions that understand silver's significance very well and have a vested interest in ensuring that understanding remains as narrow as possible. Because a widely understood silver market is a silver market they cannot control. The strategic case for accumulation, therefore, does not rest on speculation or optimism. It rests on a straightforward reading of supply constraints, industrial demand trajectories, historical valuation ratios, and the institutional behavior patterns that have characterized silver markets for decades. Serious wealth preservation has never been built on following the consensus. It has been built on identifying the gap between what is publicly stated and what is structurally true, and positioning accordingly before that gap closes. The gap around silver is closing. The institutions that have managed it know this. The only question that remains is how many ordinary investors will understand it in time.